Well, hello everyone, it is Ben Hardy here, and in today's video I have to talk to you guys about the debt crisis that we are having in the US here with cars. It is way worse than the headline figures suggest. But before we get into this video, as always, if you want to save time and money the next time you purchase a car, link to my car buying guide in the description down below. And then if you want to see more videos just like this, then I recommend you subscribe because I post content every single day. Let's get into it. I want to start this video off by going over some numbers because these numbers are very important to set the stage for what we are about to talk about. So first off, 85% of people that buy a brand new car here in the US at this point are going to take out a loan to buy that vehicle. Now with used cars, the loan rate is far lower, but this is skewed by all of the inexpensive used cars that are sold. There are tons of transactions with used cars under $5,000 on a daily basis within the car market. And well, if you're going to buy a car that inexpensive, you're not going to take out a loan on that car. However, if you look at the used cars that are $10,000 and plus, those cars have a loan take rate far higher. And this thing I can tell you anecdotally, when I worked at the dealership, if we had a car on the lot that was, again, $5,000 or cheaper, people always pay cash. It's like it's really hard to get those types of cars financed anyways. Lenders just don't want to do it. It's the amount of money they'd be able to make up with it is so cheap and the risk is so high, it's just not typically worth it. But as soon as cars got over that $10,000 price range, the take rate was super high. Like almost everyone financed. It was crazy. I'm like, $10,000. I'm like, you could wait for a year and save up this amount of money. Like at most jobs, right? If you live frugally, but no, people always took out loans. It was pretty crazy. And so that leads us to having an average new car loan payment per month of over $700. Now that doesn't take into account insurance or maintenance. We'll talk about that in just a second. Used cars, on the other hand, over $560 per month. So once you take into account insurance and all the other costs with vehicles, with a new car, you're probably looking more like, $900, maybe even $1,000 per month. And then with a used car, probably, at least $600, if not $700, $800 per month. So cars are costing Americans quite a bit of money per month. And what you have to remember is the average American household is in the $70,000 range per year with their income. And so, you take, let's just say $700 per month, and you do that over the course of 12 months. We're talking about $8,400 per year. And if you're making $70,000 per year, that's a huge chunk of your income. Anyways, the next figure is going to be negative equity. Right now, about 17% of people that are trying to go and buy a car find out that they are upside down in their car where they owe more than what it's worth. And they have an average of like $6,000 something in negative equity, which is quite substantial. And mark my words, that figure is going to increase as this year progresses. Like, don't be shocked if I give you a figure at the end of the year where the average person has $10,000 in negative equity that's upside down, and it's like 30 or 40% of buyers. Again, mark my words on that. Now, the next thing is going to be the savings rate here in the US. The median savings rate is about $5,300 here in the US. I'm not going to use the mean rate. The mean rate is over $40,000. And the problem with using the mean is there's a lot of high net worth individuals here in the US that just basically pull that savings rate just to the moon. And seriously, like if you just go on the street and ask the average person how much money they have in their bank account, the chances of them having $41,000 in their bank account is slim to nothing, but the chances of them having somewhere around $5,000 in their bank account, that's a lot more realistic. So with the numbers out of the way, we need to talk about how this could be an absolute recipe for disaster. Like this could put us in a situation where the market declines that we've seen right now just look like child's play. I'm dead serious. Like this is probably the worst thing that I have researched into so far within the channel. So again, you have the average consumer that's taking out a loan on a brand new car. And then if it's a more expensive used car, well, the average consumer is also taking out a loan on that. So all these people are exposing themselves to the potential to have negative equity. And like I said, the current rate of people that have negative equity is actually really low because historically, you're usually going to see about 30% of consumers that have negative equity. And again, this is what I saw when I worked at the dealership. Almost all of the customers that I'd work with would either be, breaking even on a car or they would owe more on the car than what it was worth. It was very rare that I saw people have a position where they actually were positive in the car. Like every single time that I had a consumer come in and purchase from me that actually was positive in their car, I was like, what? Are you real? Like, are you seriously? Like it was always shocking because it just never happened. We're definitely going back to that because again, we are seeing huge market declines and the rate of people that have negative equity is increasing as the months go on. And this wouldn't be such a bad situation if the average person had enough money to cover that negative equity. But again, if you look at the median savings rate, the average person has less money in their bank account than how much they have in negative equity if they happen to have negative equity. And so you can, put two and two together and see how this could lead to some pretty bad things within the market. So first off, this is going to lead to more people keeping their cars for longer than before, which on the surface might sound good. And a lot of you that are financially responsible will be like, that's the thing that you should do. And hey, I agree with you, but it's actually going to wreak havoc on the car market, because that means that dealerships are going to be getting fewer trade-ins, right? So they're going to have less inventory to sell, which you think would actually increase prices. But some of these customers could have been customers that would have bought used inventory that are now not going to buy used inventory. So it's actually going to help with increasing inventory at dealerships on a used car basis. And then on the new car side of things, it's also going to increase inventory because, again, frankly, less people are just going to be purchasing cars in general because they just have to keep the cars for longer. Lending institutions don't really like having to deal with negative equity, especially in the current market, because, again, when you have wholesale values on cars declining on a week-to-week basis by a substantial amount, lending institutions see that and they're like, yeah, we don't want to, be on the bad end of this whole deal with, the repossession side of things if that happens. And that's something else to mention. If you have a situation where the market shifts and we go from having a negative equity rate of 17% to 30, 40, maybe even 50%, well, that puts a lot of people in a position where if they can no longer make their car payment, they have one of two choices. They either have to pay off their car loan, which, again, the average person doesn't have enough money to do that, or they just have to simply stop making their car payment and have their car repossessed, which would obviously put a massive amount of downward pressure on the car market, because first off, well, repos would, obviously be sold on the car market, so that's more supply. But repos are not usually the best example of a car, because if someone can't make their car payment, then they're probably not also keeping up with the maintenance on a car and just generally not taking care of it. Again, if you know that a car is going to get repossessed that you have, you're probably going to drive it like you stole it. You're like, you have nothing to lose at that point because you know that your credit's going to get wrecked because of that repossession. So it's like, whatever, let's just party it up at this point. And this is something that I saw in person at the dealership, because I had a chance to see several cars that were repossessed, and let me tell you, they were a train wreck every single time. Just to get those cars reconditioned and, frontline ready, it almost always wasn't worth it. And so a lot of times they were just sold at auction. So in summary, we really do have an auto loan debt crisis here in the US, and it's only going to get worse as time goes on, because, again, cars are going to continue to decline from a wholesale perspective in value as the months go on throughout the 2023 sales year at a much more rapid rate compared to what we normally see. That is what the current trend is. So this means that more and more people are going to be underwater with their loans, and interest rates aren't coming down anytime soon. So it's not like, going into a new car is going to become any more affordable. And on top of that, again, we are in an economy that is not great right now. There are a ton of layoffs throughout the general economy. Like it's just not a good situation. And so although this is a topic that is currently only being talked about within kind of like, the car influencer world, whatever you want to call it, don't be shocked if you start to see this being talked about more in mainstream media and, frankly, with politicians as well, because there's probably going to have to be some sort of bailout in the future. Like, I know that sounds crazy. Like, I don't think this is going to be like, '08 housing crisis levels of bailout, because, again, cars are significantly less money than houses. But with the amount of auto loan debt we have here in the US, the average savings rate of the average individual, it's unsustainable at this point. It really is. Again, if we were in a car market where values weren't declining at this rate, and if we were in an economy where, it was easy to get a job and it was easy to make money, then again, this wouldn't be a problem. But we don't have either of that right now. Again, jobs are disappearing as the days go on, and cars are just continuing to lose value as the days go on as well. And so it's just not a great situation. So that's going to sum things up. I want you guys to let me know what you do as a consumer to, prevent yourself from being in a situation where you have negative equity. And if you guys don't know, my take on this is always, if you're going to buy a new car or a used car, at least put enough money down to cover tax, title, license, and other state fees, so you're not taking out a loan on any of those fees. And then on top of that, you should try to put another 20 to 30% down on top of covering all the fees, so that if the market does decline, then you're still at least, maybe breaking even on the car if it declines at, a 20 to 30% rate compared to what you paid. That's just what I'd always do. Even when I personally took out car loans, which I don't anymore, but when I did, I always made sure I put a ton of money down just in case. And I think that's always the smartest thing to do. Like, always ask yourself, like, do you need a new car today? And if the answer is you don't really need a new car, then, set yourself up to be in a position where you can put a little bit more money down when you do buy that car, so that, again, you don't put yourself in a bad situation. And if you're wondering, this is what dealerships want too. Like, people seem to think that dealerships don't want people to do this, but dealerships actually, and again, I can say this as someone who worked at a dealership for several years, dealerships don't want you to be super upside down, because it makes it harder for them to sell you cars in the future. Like, in an ideal world, dealerships would want all of their customers to have neutral equity or positive equity, so they can continue to sell them cars on a regular basis. Anyways, that was a lot. That's going to sum things up. I'll see you guys.